Hello, and welcome to Edgemoor Investment Advisors video presentation of our second quarter 2026 market review and outlook. I am Steve LaRosa, and I am joined today by my colleague, Gay Truscott. Our agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, edgemoorinv.com. Here are the topics we will cover today: a second quarter 2026 market review, what's driving this market, the U.S. economy, positive factors and headwinds, what we are watching for next, Edgemoor's outlook, as well as portfolio implications and actions, and finally a review of one selected security. Let's get started. Equity markets rebounded strongly during the second quarter ended June 30th, 2026, after their sharp sell-off in March tied to the start of the U.S.-Iran war. Volatility, as measured by the VIX index, peaked in late March and subsided for most of the second quarter. The S&P 500 index, the broadest measure of the U.S. equity market, posted a total return of 15.2% in Q2, its best second quarter performance since 2020. It also reversed the negative total return in Q1, resulting in a year-to-date return for the S&P 500 of 10.2%. Stocks in the technology sector reclaimed the top position in terms of quarterly performance, returning 31.8% in Q2, driven largely by surges in semiconductor chip makers and other beneficiaries of artificial intelligence-related spending. However, other sectors such as industrials, financials, and healthcare also posted strong returns as the overall market continued to broaden beyond the Magnificent Seven technology behemoths. Meanwhile, bond returns were essentially flat, with the Bloomberg Aggregate U.S. Bond Index returning just 0.7% in the second quarter and 0.6% for the first half of the year. Interest rates have remained high as the bond market wrestles with stubbornly high inflation and fiscal deficits. Many investors have been asking the question, how does the stock market keep hitting new highs when the world seems to be filled with so much turmoil? To answer that question, we need to look at corporate earnings. We have often said that corporate earnings are arguably the largest factor driving the long-term performance of the stock market, and we are seeing that play out in real time today. While day-to-day headlines may move markets in the short term, it is the broad fundamentals of the U.S. economy, most notably corporate earnings, that drive markets higher over the long term. And right now, corporate earnings are on a tear. They've been growing at double-digit rates for the last 3 years and are showing no signs of slowing down. The growth is partially explained by the many companies benefiting from massive AI spending, but it's not actually all tied to AI. Other sectors, including energy, communication services, and materials, have also seen significant earnings growth so far in 2026. For the full year 2026, the S&P 500 index is expected to report year-over-year earnings growth for its underlying companies of 24.1%, after growing 13% year-over-year in 2025. For 2027, current estimates are for earnings to grow 17% year-over-year. We believe that strong corporate fundamentals, which include earnings growth, revenue expansion, and balance sheet strength, provide the underpinnings for positive, sustainable market returns over the long term. The massive capital expenditures related to artificial intelligence continue to be a defining force in the global economic landscape. A multi-year CapEx cycle is underway across data centers, power generation, and chip manufacturing, with more than $5 trillion projected to be spent through 2030. Adoption of AI across the broader economy is also accelerating, laying the foundation for future productivity and profitability gains. Already, U.S. labor productivity is trending at nearly 2 times higher than it has over the last 15 years, even as AI has only started to penetrate various areas of the economy. This suggests to many that we are in the early stages of a long-term, AI-driven productivity and growth cycle. U.S. economic output, as measured by GDP, grew at a solid annual rate of 2.1% in the first quarter of 2026, and is projected to grow 2.3% for the full year of 2026. Consumer spending, which makes up nearly 70% of US GDP, has held up in the aggregate this year, despite the headwinds of inflation. And while labor markets are somewhat weaker than they were in the post-COVID era, they have generally stabilized in a lower growth mode. The overall unemployment rate has stayed relatively steady at around 4.2%, in line with recent historical averages. Overall, these positive factors suggest slow but steady economic growth, with little near-term risk of recession in the US economy. Of course, the US and global economies still do face several economic headwinds, which could delay or derail near-term growth. The most concerning issue is inflation, which has evolved meaningfully since the start of the year and continues to impact almost every sector of the economy. Higher inflation has also meant higher interest rates. At the beginning of 2026, investors expected the Federal Reserve to cut interest rates during the year. But that expectation changed with the inflation pressures brought on by the Mideast war, and the Federal Reserve has kept their target Fed funds rate unchanged so far this year. We will be watching closely for additional signs from the new Federal Reserve Chair, Kevin Warsh, about his views on inflation and interest rates. We are also closely monitoring the continuing AI boom and whether the seemingly endless demand for new data centers, power sources, and chip manufacturing will continue to drive growth across the economy. And finally, we will be watching the lead up to the November midterm elections, which could cause some short-term volatility in the markets. Despite that potential volatility, we will be sticking to our long-term investment philosophy and not acting on short-term political events. And now I will turn it over to Gay to talk about portfolio implications and actions, our outlook, and to review a selected equity security.
Thank you, Steve. I'm going to begin with our outlook for the U.S. economy and markets. We expect market volatility may continue in the near term until there's more clarity around the war in the Middle East, the direction of inflation and interest rates, and the outcome of the midterm elections. But we still remain optimistic about the longer-term prospects for the U.S. economy and the stock market. We expect that markets will continue to reward companies with strong competitive advantages, good growth prospects, healthy balance sheets, and shareholder-friendly management teams. Exactly the kinds of companies we like. We also look for the market to continue to broaden beyond technology or AI-related sectors, as growth and productivity gains are realized across other sectors of the economy. From a valuation standpoint, the S&P 500 index is currently trading at approximately 20 times forward earnings, roughly in line with its 5- and 10-year averages. But not all sectors or all companies are fully valued, so we remain actively focused on finding new opportunities to buy great companies at prices below their intrinsic value. Now let's move to portfolio implications and actions. Because of our disciplined, patient approach to individual security selection, we have been able to find pockets of opportunity in today's market, even as the S&P 500 continues to notch new highs. In the second quarter, we added 3 new securities to our equity buy list: Boeing, Eli Lilly, and DXJ, a Japan hedged equity fund. We believe each of these holdings represents a unique opportunity to add great new companies that are not directly tech or AI related to client portfolios, thereby enhancing the diversification and defensive elements to reduce their overall risk profiles. We also continue to favor high-quality bonds and dividend-paying securities that generate current income for clients with balanced portfolios. With current yields of 4 to 6%, these securities offer an income cushion that offsets the potential volatility of equity holdings. We also find 6 to 12-month Treasury bills with annualized yields of 3.8 to 4% attractive. Overall, our long-term, time-tested investment philosophy continues to favor high-quality companies with strong revenue and cash flow characteristics, leading market shares, wide economic moats, and solid growth prospects. We believe our active approach to individual security selection leads to broadly diversified portfolios across industries, market capitalizations, and geographies, allowing our client portfolios to weather market turmoil and be well-positioned for long-term growth and appreciation. Now I'd like to discuss one of the new securities we are currently buying for client accounts, Eli Lilly. Eli Lilly is the largest pharmaceutical company in the world by market capitalization, which currently tops $1 trillion. Headquartered in Indianapolis, Lilly engages in the discovery, development, manufacture, and sale of pharmaceutical products in the areas of diabetes, oncology, immunology, neuroscience, and others. Lilly is a truly global company, operating R&D facilities and manufacturing plants in 7 countries, conducting clinical research in more than 55 countries, and selling its products in 125 countries worldwide. Eli Lilly has experienced exponential growth in recent years tied to the success of its diabetes drug, Mounjaro, and its obesity and weight loss drug, Zepbound, both of which have grown to become multi-billion-dollar products. But Lilly has a long history of producing blockbuster drugs, making Mounjaro and Zepbound just their latest global successes. Lilly also possesses a wide array of other drugs in its portfolio and its pipeline, many of which enjoy patent protection for many years to come. The company's wide economic moat is rooted in these patents, as well as in its size, scale, powerful distribution network, and pricing power. Looking ahead, Eli Lilly should benefit from the continued expansion of the global addressable market for many of its primary drugs. For example, the shift from injections to oral medications for its diabetes and weight loss drugs is a huge growth catalyst, as it eliminates a major point of friction for users and unlocks an entirely new population of patients. Lilly continues to execute on a targeted acquisition strategy, while also building out the largest domestic manufacturing expansion in its history, with more than $50 billion committed to expanding U.S. manufacturing. Lilly also recently entered into a multi-billion-dollar strategic collaboration with NVIDIA, aimed at integrating advanced AI, accelerated computing, and robotics into its pharmaceutical research and supply chain infrastructure. All of these initiatives provide the company with a long runway for continued growth. Shares of Lilly are currently trading at about 29 times their next 12 months' earnings, meaningfully below the 5-year average multiple of 37 times, which offers investors a comfortable margin of safety. The company's stock is also significantly less volatile than the market, with a beta of less than 1. Given the company's discounted equity valuation, industry-leading market position, and huge growth trajectory, we believe shares of Eli Lilly are an attractive core holding for our clients. That concludes our second quarter 2026 video presentation. We hope you have found it interesting and informative. We always appreciate your feedback, so please feel free to contact us with any comments. Otherwise, we hope you will tune in again next time. Thank you and happy summer.